Welcome back to the channel. Near Protocol could be approaching a decisive moment, and the latest market data is sending mixed signals that every investor should be paying attention to right now. The token is currently trading at $1.94, down 6.85% over the last 24 hours, while trading volume has surged to $138.5 million. At first glance, this may look like another routine pullback. However, when we look deeper into the technical indicators, trader positioning, and derivatives data, a much more interesting story begins to emerge. The big question is simple. Is Near preparing for a recovery, or is another wave of downside pressure about to hit the market? In today's video, we're going to break down everything happening with Near Protocol, including the recent price decline, the battle between buyers and sellers, critical support and resistance levels, momentum indicators, derivatives market activity, and what these signals could mean for the next major move. Let's get started. This video is for informational purposes only and is not financial advice. Always do your own research or consult a professional before making any investment decisions. The first thing traders noticed was the sharp decline that pushed Near down to around $1.82 before buyers finally stepped in. This bounce initially looked encouraging because it showed that demand still exists at lower levels. Buyers were willing to defend the market and prevent a deeper sell-off. However, the recovery quickly ran into trouble. After bouncing from $1.82, Near attempted to reclaim the psychologically important $2 level. This is where things became interesting. Instead of building momentum above that level, the price stalled and eventually moved back lower. This failure to hold above $2 is important because psychological levels often play a major role in market sentiment. Traders naturally focus on round numbers, and when a cryptocurrency repeatedly struggles around these areas, it usually indicates hesitation among buyers. In simple terms, the market had an opportunity to show strength, but buyers were unable to maintain control. That doesn't necessarily mean a major crash is coming. However, it does suggest that bullish momentum remains weak and that investors are still waiting for stronger confirmation before aggressively entering the market. Now, let's talk about volume, because this is one of the most important developments happening right now. Trading volume surged to approximately $138.5 million, which is a significant increase compared to normal activity levels. Whenever volume rises during a decline, traders pay close attention, because it reveals that market participants are actively making decisions. This isn't a situation where investors are simply ignoring the market. Instead, large amounts of capital are moving around. Higher volume can mean different things depending on the context. Sometimes it indicates panic selling. Other times, it reflects strategic accumulation by larger investors who see value at lower prices. The challenge is determining which scenario is taking place. Looking at recent data, there is little evidence of panic. Instead, the market appears to be experiencing steady and organized selling pressure. This suggests that some investors are gradually reducing exposure rather than rushing for the exits. That distinction matters because panic selling often creates dramatic crashes, while controlled selling usually leads to slower and more predictable price movements. Next, let's examine momentum indicators. One of the most widely followed indicators in technical analysis is the Relative Strength Index, or RSI. The RSI currently sits around 45.66. For those unfamiliar with RSI, readings above 70 generally indicate overbought conditions, while readings below 30 suggest oversold conditions. At 45.66, Near sits directly in neutral territory. This tells us something important. The market is not excessively bullish, but it is not extremely bearish either. Traders are undecided. There is enough buying interest to prevent a complete breakdown, but not enough conviction to trigger a major recovery. This type of environment often leads to consolidation and uncertainty as market participants wait for stronger signals. Now, let's look at the MACD indicator. The MACD histogram is currently hovering near the zero line, showing very little momentum in either direction. This is another sign that the market lacks a clear trend. When MACD begins to flatten out, it usually means traders are waiting for a catalyst. They want fresh information before making larger commitments. In other words, Near is currently trapped in a waiting game. Neither buyers nor sellers have managed to establish complete control. But the technical picture becomes even more interesting when we examine the broader chart structure. One of the strongest bearish signals right now is the fact that Near continues trading below several important moving averages. The 7-day SMA sits near $2.36. The 20-day SMA sits near $2.26. Both of these levels are positioned above the current market price. This means that every recovery attempt will likely face resistance as traders who bought higher look for opportunities to exit positions. Think of these moving averages as ceilings hanging over the market. Until Near can break above them and remain there, many traders will continue viewing the overall trend as bearish. The first major challenge sits around $2.10.
If buyers manage to reclaim this area, market confidence could begin improving. However, even if that happens, another major resistance zone waits around $2.25, where multiple technical signals converge. This level aligns with a key exponential moving average and could become a major obstacle for any bullish breakout attempt. In short, buyers have a lot of work to do before they can regain full control of the market. Now let's discuss support levels. Support is where buyers have historically stepped in to defend prices. The nearest important support comes from the 50-day SMA, which sits near $1.76. This level currently acts as a cushion beneath the market. As long as NEAR remains above $1.76, there is still an argument that buyers are attempting to defend the broader trend. However, if this support eventually fails, attention could quickly shift toward the critical $1.67 area. A breakdown below $1.67 would likely increase bearish sentiment significantly and could trigger additional selling pressure. This is why support levels matter so much right now. They represent the line between stabilization and further weakness. Another indicator worth examining is the Bollinger Band position. Current readings show NEAR trading near the lower portion of its Bollinger Band range, with a reading around 0.28. This suggests that selling pressure remains dominant. When prices move toward the lower end of the Bollinger Band range, it often indicates weakness and limited buying enthusiasm. However, it can also signal that the market is approaching areas where rebounds become more likely. This creates a fascinating situation. On one hand, the trend remains weak. On the other hand, the market is approaching levels where value-oriented investors may begin showing interest. Now let's move into what may be the most important part of today's analysis: the derivatives market. While the spot market has looked weak, derivatives data is telling a much more complicated story. Open interest recently jumped by approximately 20%, reaching around $109.5 million. This is a significant development. Open interest measures the total value of active futures and derivatives contracts. When open interest rises sharply, it indicates that traders are opening new positions and preparing for larger future moves. What's particularly interesting is that open interest increased while the price was falling. This means traders are becoming more active despite the decline. They are not leaving the market. Instead, they are positioning themselves for what they believe could be the next major move. This often happens before periods of increased volatility. Now, let's discuss funding rates. The current funding rate remains negative at approximately 0.0065%. A negative funding rate means short sellers are paying traders holding long positions. This reflects bearish sentiment because more traders are betting on lower prices. At first glance, that sounds negative. But experienced traders know that excessive bearish positioning can sometimes create powerful reversal opportunities. If too many traders become convinced that prices will continue falling, even a modest recovery can force short sellers to close positions. That buying activity can accelerate rallies and create surprisingly strong upward moves. And this brings us to perhaps the most surprising statistic in today's report. Despite recent weakness, top traders continue holding approximately 54.5% of positions on the long side. Think about that for a moment. The price is struggling. Momentum indicators remain weak. Resistance levels continue blocking recoveries. Yet professional traders still maintain a majority bullish position. Why? One possible explanation is accumulation. Accumulation occurs when larger investors gradually build positions while prices remain relatively low. Instead of chasing rallies, they quietly acquire assets during periods of uncertainty. Historically, these phases often look boring while they are happening. Prices move sideways. Sentiment remains cautious. Most investors lose interest. But beneath the surface, larger players slowly increase exposure. Of course, accumulation cannot be confirmed with certainty. However, the disconnect between professional positioning and recent price action certainly raises interesting questions. Could smart money be preparing for a future recovery? Or are these traders simply managing risk differently than retail investors? The answer may become clearer in the coming weeks. For now, NEAR remains at a critical crossroads. The short-term trend continues favoring caution. The market remains below major moving averages. Momentum indicators show limited strength. Resistance levels remain firmly in place. But at the same time, rising volume, increasing open interest, and continued long positioning among experienced traders suggest that confidence has not completely disappeared. This is why the next few trading sessions could be extremely important. If buyers can reclaim key resistance levels and maintain momentum, sentiment could improve rapidly. However, if support levels begin breaking down,
sellers may gain additional control and push the market lower. Either way, volatility appears increasingly likely. To summarize everything, Near Protocol is currently trading at $1.94, down 6.85% in the last 24 hours, while volume has surged to $138.5 million. The token successfully bounced from $1.82, but failed to hold above the critical $2 level, highlighting continued buyer weakness. Technical indicators, such as the 45.66 RSI and a flat MACD, suggest neutral momentum, while moving averages continue acting as major resistance. At the same time, open interest has climbed 20% to $109.5 million, and top traders still maintain 54.5% long exposure despite negative funding rates. These mixed signals suggest that although the short-term trend remains fragile, larger investors may still be positioning for potential upside in the future. The coming days could determine whether Near begins a recovery or faces another leg lower, making this one of the most important periods for the project in recent weeks. Thanks for watching. If you enjoyed this video, make sure to like, subscribe, and turn on notifications so you never miss the next update. See you in the next one.